Welcome to the Wealth Wisdom, where money has history and knowledge becomes power.
Imagine waking up in your country one morning to chaos you never expected. The currency has collapsed. Inflation is spiraling. Banks are shuttered. Ordinary citizens stand in long lines just to buy bread and milk. The government promises action, but nothing seems to work. Meanwhile, behind closed doors, a small network of financiers, politicians, and global institutions quietly reshapes the economy, deciding who prospers and who struggles. It feels random, but it's not. There's a system at work, invisible, strategic, and centuries in the making. Most citizens never notice it, and even fewer truly understand it. Today, we're peeling back the curtain on the history, the methods, and the modern realities of this global power structure. By the end, you lions never look at world events, or your own country's economy, the same way again. Setting the stage, understanding power beyond borders to grasp why some nations thrive while others falter. We need to look beyond borders. A country isn't just a collection of citizens, laws, and resources. It's a node in a vast global network connected to trade, debt, finance, and geopolitical maneuvering. We like to believe prosperity is earned, hard work, innovation, and wise governance. History, however, tells a different story. Wealth and collapse are often dictated by forces beyond national borders. Banks, multinational corporations, trade agreements, and supranational institutions like the IMF or World Bank. These power structures are invisible to most. They don't appear on election ballots or news broadcasts, yet they shape currencies, control interest rates, and decide who gets loans, who attracts investment, and which nations are left behind. Origins: how control over nations began. The story starts centuries ago. In the age of empires, wealth wasn't measured by GDP, it was measured in land, precious metals, and control over trade routes. Nations rose and fell not just through armies, but through access to credit, capital, and international markets. Take the Medici in Florence, the Dutch East India Company, or British colonial financiers. These weren't just bankers, they were decision-makers who influenced wars, infrastructure, and national policy. Loans came with strings attached, political leverage, resource rights, even control over policy decisions. By controlling access to capital, they could shape entire nations without a single soldier crossing a border. By the 18th century, sovereign debt became an instrument of influence. Countries borrowed to fund wars, railroads, and industry. Those who controlled the capital dictated the terms, repayment schedules, trade agreements, even domestic policy reforms. Economic dependency was born. Rise, institutions, and the consolidation of global power. Fast forward to the 20th century. Industrialization, world wars, and global finance reshaped power entirely. Central banks, international trade agreements, and institutions like the IMF and World Bank formalized control over nations' economies, often in ways that benefited the already powerful. Consider post-World War II Europe. The U.S., through the Marshall Plan, provided loans and aid to rebuild. On the surface, it was generosity. In practice, it created markets for American goods and tied European economies to U.S. policy. A precedent was set. Those with capital could dictate the rules of recovery. Debt and currency systems became levers of influence. Nations with access to favorable credit, investment, and trade opportunities flourished. Those without it were left vulnerable, often struggling to keep up. Breaking point: crises as instruments of influence. History moves in cycles, and crises reveal who truly holds power. When a nation faces economic collapse, the wealthy and connected rarely lose, they profit. Take Latin America in the 1980s. Countries borrowed heavily to build infrastructure and modernize. When global interest rates rose and commodity prices fell, nations like Mexico and Brazil couldn't pay. Institutions like the IMF stepped in, ostensibly to help. In reality, austerity measures, privatizations, and restructuring dictated by foreign creditors left citizens paying the cost while external powers controlled the recovery. The 1997 Asian financial crisis followed a similar pattern. Thailand, Indonesia, and South Korea experienced currency collapses and soaring debt. International institutions intervened, often imposing policies that opened markets to foreign investors while local populations bore the hardships. The lesson was clear. Crises are opportunities for those who understand and control capital. Fallout. How ordinary citizens are affected. The impact on ordinary people is staggering. Inflation rises, unemployment grows, debt becomes unmanageable, wages stagnate, social mobility declines, essential services are cut. Meanwhile, those who hold assets, credit, and influence consolidate wealth and power. Consider these real-world examples. During Argentina's 2001 collapse, over half the population fell below the poverty line, while global investors profited from distressed asset sales. In Greece, the 2010 debt crisis brought severe austerity. Healthcare and pensions were slashed, unemployment soared, yet banks and creditors remain protected. A pattern emerges: the wealthiest and most connected benefit during crises, while ordinary citizens pay the real cost, often unknowingly. Failed fixes, attempts to break free governments, have tried to resist external control, capital controls, debt restructuring, and protectionist policies. Sometimes these measures work temporarily, but the system adapts. Global capital moves at lightning speed. Financial innovation creates new tools of control, derivatives, hedge funds, complex sovereign debt structures. Even digital currencies and modern trade agreements are woven into this architecture of influence. The elite understands these tools first. Nations with less access and information left constantly reacting. Modern parallels. Today's global power structures. Power today is more sophisticated than ever. Multinational banks, global credit agencies, trade agreements, and supranational institutions interconnect nations. Money, policy, and trade are tightly woven. Consider quantitative easing after the 2008 financial crisis. Trillions were injected into markets. Asset holders benefited first, while wages stagnated and living costs rose for ordinary citizens. The cycle repeats: stimulus, recovery, inequality, all within the bounds of legality and global rules. Countries burdened with debt must follow fiscal rules set by creditors. Interest payments, conditional loans, and market pressures influence domestic policies, often overriding local priorities. Prosperity or collapse isn't random, it's engineered. Key takeaways: economic outcomes are engineered. Prosperity and collapse follow patterns shaped by global power, finance, and capital networks. Debt is a tool of influence. Governments, institutions, and creditors can steer nations without force. Recognizing this is essential. Awareness changes perspective. Citizens and policymakers can protect themselves only if they understand how money, power, and policy interact globally.